traders, Gavin McMaster here from Options Trading IQ, and today we're going to be looking at selling cash secured puts and specifically doing that on interactive brokers. So they're a great strategy to start with for beginners, and you can generate income if the put expires worthless, or you get to buy the stock for a discount. So pretty much either way, I'm happy when I'm selling a cash secured put. Either I collect the income and I keep that as a nice return, or I get to buy a great stock at a discount. Before we get started, just a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So what is a cash secured put? A cash secured put is when you sell a put option and you set enough cash aside to buy the shares if you get assigned. It's perfect when you're willing to buy the stock at a lower price than where it's currently trading and you want to get paid to wait. Let's take a look at how to sell a cash secured put on interactive brokers. So the first thing we want to do is select a great stock. So it's got to be a stock that you're willing to buy and hold for the long term, and you're happy to take ownership of it if called upon to do so. Let's just use Wells Fargo as an example, and we're going to look at a couple of different examples. But basically we start off, we type in the ticker, we hit enter, we go to options, and this will bring up our options chain, and now we've got to select our expiration date. Shorter term options are going to provide the highest theta and the highest annualized return, but they're going to be closer to the money or closer to the stock price. If we choose a much longer term expiration, we can generate similar premium for going further out of the money, and we've got a lower cost price or potential assignment price, but our annualized return is going to be lower. For most people, they're going to be looking at sort of monthly options. You can do them weekly. Depending on the stock, there might not be a lot of premium. If it's a high volatility tech stock, there will be a lot of premium, and we'll talk about that in a minute. But for a stock like Wells Fargo, if we look at our weekly options, there's not that much premium here. So we pretty much have to go out to our regular monthly expiration, which is July 18. And let's say we're happy to buy it at 77.50. We'll click on that option there, and that brings it into our main window. This is TWS Classic, by the way. You can use Mosaic. I just prefer Classic. Here we've got our bid, mid and ask prices. So we know the midpoint is around 151. And to sell that option, we're just going to left click on the bid to bring up a sell order. So I know the midpoint's about 151. I want to get filled around that price. I'm probably going to put the order in at 155, see if I can get filled at a slightly better price than the midpoint. And I might just change that to good till cancelled rather than a day order. And once I hit transmit, the order is live in the market. I have a little spreadsheet that I use to calculate the annualized return. So let's have a quick look at that. So here it is here, just a quick Excel calculator. I just need to fill in the cells in green and that's it. So our expiration in this case is July 18. The stock price, haven't got it here. Let's just add the actual stock in. So the stock's trading at 80.05. Our strike is 77.50, and we're going to get filled hopefully at 155. Just doing the one contract, that gives us our capital at risk or our maximum loss, which is equal to the strike price minus the premium. And our potential break-even price or our cost price, if we do get assigned at 77.50, is going to be 75.95 thanks to the premium received. So the actual cost to buy the shares is less than 77.50 because we can take into account the premium. That's about 5% below where it's trading right now. So we either get to buy the stock for a 5% discount, or if it expires worthless, we're going to achieve about a 34% annualized return, which is really good. Let's compare that if we were going to sell a longer term option. So let's look at that December expiration. And we'll keep the strike price the same, 77.50. Midpoint's 470. If we were going to do this one instead, I might put my order in at 470 or 475, see if I can get filled at a slightly better price. Maybe the stock comes down a little bit during the course of the day and we get filled at that better price. So strike price is the same. Our date is different, 12/19, and our premium in this case is 475. Now we're getting a 10% nearly margin for error or decrease to our break-even price, 9%, but only a 13% annualized return. Even though we're generating a higher premium, because it's taking us longer to get that premium, our annualized return is a little bit lower, actually significantly lower in this case. So I would probably go with that July expiration if I'm happy to buy the stock at 77.50. Let's now compare that to a high volatility stock. So let's look at SMCI. We'll add the stock just so we've got the stock price for our calculator. We'll go to our options chain. We use the July, And the delta on this one was about 32. So let's keep the delta around the same so that we can try and make a decent comparison. So that 33 delta is the 46.50 strike, and that's trading about $2.10. So again, we come in here, we click the bid price, brings up our sell order, and we might sell that for say 210. And let's compare that here. And in this case, we're getting 210. So now we've got a 10% decrease to our break even on a short-term option, and we've got a 78% annualized return, which is a lot higher than Wells Fargo. But that makes sense, right? Because SMCI is a much more highly volatile stock. So we need to be compensated for taking that risk of that high volatility stock. I'm not saying one's better than the other. I'm not saying this trade's better because the annualized return's higher, or the other one's better because the stock's a lower risk stock. It's just personal preference on which type of stock you want to trade. And that might depend on where you're at with your trading and in the stage of life. Younger people might prefer to take a high risk approach, whereas older people might be preferring a lower risk, more income-based approach. So there you go, really easy to enter those trades. We can do that in just a couple of minutes. So we've got our little calculator there to analyze things as well. Once the trade gets a bit more involved and we turn it into a wheel trade, which I've got other videos on if you want to check those out, I track everything in this wheel tracking spreadsheet. So this is one that I've been working on for a couple of years now, and this tracks all our cash secured puts, buying of the stock, covered calls, dividends, etc. And it shows our overall P&L and return compared to the return on the stock. So I'll provide a link in the description below if you want to download this template as well for tracking your cash secured put and wheel trades. So what happens after you sell the put? We've seen how to open the trade, how to initiate the trade by selling that put option. And once the trade is live, you've got two possible outcomes. Firstly, the stock could stay above the strike price, which is great. The option expires worthless. We've kept the full premium. We can start again by selling another put option, or we could move to a different stock. If the stock falls below the strike price, you get assigned and you have to buy 100 shares at the strike price. Generally speaking, I'm happy either way. Either I keep the premium and I've made a nice annualized return, or I get to buy a great stock at a lower price than what it was trading when I first started the position. Let's talk about some of the risks and best practices. So while it's a conservative strategy, there are still risks, mainly that the stock drops sharply below your strike price. And maybe you've had this happen. If that does happen, you have to decide if it's a stock you want to hold for the long term, whether you want to average into the position and dollar cost average by buying more shares at a lower price or selling another put, or do you exit the trade and move to a different stock? So really you want to be only selling puts on stocks you want to own and you're happy to own for the long term, because if it does drop significantly, you could be potentially stuck holding that stock for quite a long time before it gets back to its cost basis or break-even price. If you're starting out, keep your position size small, definitely in a small account. Selling a cash secured put is actually a little bit difficult with a small account because, a stock like Wells Fargo, to buy 100 shares, we saw about $7,500. If you've only got a $10,000 account, that's very hard to do. You're basically exposing your entire account to that one stock. If you have got a small account, you might prefer to look at strategies like a bull put spread. And I've got videos on that as well if you want to check it out. This is probably the important one for me, is to stick to high quality liquid stocks or ETFs. You want to be sticking to the best of the best, blue chip stocks, stocks with great earnings, great long-term potential, and you want to be avoiding high risk stocks, recent IPO stocks. Don't get sucked in because they've got really high volatility and the option premiums are high. Stick to quality companies, blue chips that you're happy to hold for the long term. And ETFs as well don't have any stock specific risk. A company could potentially go bankrupt, whereas an ETF is generally not going to go to zero. You should avoid earnings announcements if you want lower volatility. Now, you can actually trade cash secured puts over earnings if you're okay with the risk, because the implied volatility is always elevated, which means higher option premiums, or for the same amount of premium that you would normally get, you can actually put that strike further away. So avoid earnings announcements if you're starting out, but if you're a bit more experienced and you're okay with the risk, they can actually be a great time to sell cash secured puts and get that strike price further away than you normally would be able to. And lastly, use limit orders, not market orders. So you saw there that I worked out what the midpoint was of the bid-ask spread, and then I was putting a limit order in slightly above the midpoint. That'll help you get a little bit of extra premium. Sometimes the trade won't get filled and that's okay. You just move on to the next opportunity, but limit orders are a great idea. What about monitoring the trade and rolling the position? So there's a couple of reasons why we need to monitor the trade and why we might roll the position. So it can further enhance the strategy's profit potential, and it can be a great way to avoid or delay assignment. We're going to take a look in a second. Knowing exactly when and where to roll the short put is a bit of an art that comes with practice. The choice partly depends on how much the investor wants to own the stock and at what price. So let's look at some examples. So let's use a stock like Uber as our example. It's trading around 92.80. And let's say we've sold this 92.50 put a couple of months ago, and now we're getting close to it being assigned. We're getting close to expiration. Maybe for whatever reason, we don't want to quite get assigned yet. We're not happy to take ownership of the stock just yet. We want to delay that assignment. So what we would do, we've already sold this put to open. We would come in here and we would buy this to close at around the midpoint. Then we would roll that option out to the next month or even out to September. And you can see we're getting a lot more premium by doing that. So we would buy to close this one and we would sell to open this one. And by doing so, we've generated about $250 in extra premium, and we've delayed assignment by another month. So we buy this option back for $260. We sell this new option for $505. So that's what, $245 in premium that we've received, and we've delayed assignment. Now you could do that by a calendar spread if you wanted to, because the strike prices are the same. We're just trading a different month. So that is basically a calendar spread. So that can be done via one order. Now we could also roll down and out. So instead of rolling to August and keeping the strike price the same, we could roll out to August and we could sell a 90 strike put or even an 87.50 strike put. Let's get rid of this one. So again, we buy to close this one for $260. We sell to open this one for about $296, $295. We've rolled out an extra month. We've rolled our strike price down by $5, and we've also received $35 in premium. So that's what's called a roll. We call that a roll down and out. We typically want to do that for a credit. A $35 credit isn't a lot, but we've reduced risk by rolling that strike price down. So in conclusion, cash secured puts are one of the best ways to generate income and get paid to buy stocks you already want to own. Interactive Brokers makes it easy to set up, manage, and roll these trades. And after watching this video, you now know how to do that really easily. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and share your thoughts in the comments below. Reach out anytime with questions, and have a great day.